Hey, what's up everybody? Elite Drafter back with a brand new video. In today's video, we're going to talk about credit repair and one of the other myths that I see a lot of mistakes and people make, and that's the idea that, hey, credit repair is all about negative items and just removing those negative items and then eventually going to financial institutions and applying and getting that funding. The reality is, in credit repair, there's two simultaneous activities that we really need to concentrate and focus on. The first of the many activity is the ability to remove the negative items. Yes, that is extremely important, that is crucial, that is something we need to do. But on the other side, we also need to simultaneously hopefully enhance the existing creditor relationships we have. If not, then try to establish new ones that we can harvest, grow along the way, and enhance over time. So I think a lot of times where people start to think that credit repair is very simple as to remove negative items, they completely miss the ball. And the reason why, it's because I believe 80% of your activity should be focused on harvesting your existing creditor relationships. So here's the reason I say this in a very strong and compassionate way. First and foremost, existing relationships don't necessarily require a credit pull on a regular basis. They're not going to go into your credit reports every single time you pay your bill. What it is they're going to look at your existing infrastructure, the payment history you have with them, the historical relationship you've established, and through those mechanisms help you get to an elevated perspective, increase your limits strategically depending on the algorithms, and of course give you more access to liquidity down the road. So that's the first thing we need to concentrate on. The other thing is, if you don't have established creditor relationships, then you need to concentrate on finding ways to be able to do that. There's many different avenues. Now, obviously you guys know about these primary trade lines, the non-essential primaries that I talked to you guys about, and how it's not essentially existent, and why a lot of these non-essential primary trade lines, including my Jewelers Club and so on and so forth, are falling off, and why they're no longer going to stay, right? So that's the big picture. We need to be very clear about that. Given that the fact, right, there's other ways to go about establishing personal credit. One of the many things I encourage you guys to do is try to figure out how to take a savings that you have, perhaps $3,000 to $5,000, and I would have said this in my last video, and leverage those saving accounts and take it to institutions that you feel are tier ones, like Citibank, Bank of America, Wells Fargo, Chase, and so on and so forth, and establish deposit accounts with them. From that perspective, assuming that it's $1,000 minimum or more, perhaps $850 if you don't have that kind of savings, and get a secured credit card with them. Now, you might think that that's completely counterintuitive. You're spending money to get more money. And the reality of the matter is institutional relationships, right? The ones that I just mentioned, the list of the big brand names, those guys make the most impact in your credit profile long term. The reason I say this is because the institutional accounts that you're looking at, the bank have their own independent reports. They're called the bankable reports, right? Those individual reports, alongside with your credit reports, determine an underlying criteria for funding. Sometimes if you have a lot of strategic bank reports with tier one institutions, you can get a lot more funding. And that's the ultimate goal, right? So focus, like I said, the myth here is a lot of people think just removing negative items is going to do the trick. No, focus on establishing and harvesting existing ones. If not, find new ones that you can establish with tier one institutions and focusing on growing that as well. 80% of your activity should be concentrating on enhancement. The repair side is inevitable. It's a journey, right? It doesn't happen overnight. If a lot of people out there saying, hey, look, I can fix your credit within 30, 45 days and make these claims, and over 80% of their clients don't necessarily succeed. And the reason of those who actually succeed is because it's one or two collection items that are due to fall off anyways because of statute of limitations and so on and so forth. Or perhaps it's a very simple stuff that was just lingering about it that's just taken care of by the automated systems out there, and they make it look like they did the whole thing. The reality is credit repair is a very strategic game. You need to understand exactly what you're looking for, right? We're going to have a lot more clarity coming up in this channel that'll give you a lot more insights on what to look for very strategically, and understand the game of compliance, protocol of reporting, and how creditors need to communicate with the bureaus to be effective, to make sure they were following all federal and state laws, and so on and so forth. But on that note, credit repair is a long-term game, right? As you're repairing your credit, not enhancing, but the ones that you're repairing, you're looking at a journey between 3, 6 to even 8 or even 9 months. It's a long-term game. If you're stepping into this territory thinking for yourself that, hey, look, I don't have to necessarily worry about fixing my credit because it's going to take about 30 to 45 days and then make some moves financially to go and get some funding, you got it all wrong. You need to understand enhancement also will take time, right? For example, establishing deposit accounts with institutions, seasoning those deposits, meaning spending a little bit of time with them, leveraging those accounts that they establish for your secured credit cards, those are, leveraging and using them and paying them on a regular basis and paying them down and so on and so forth. That takes time, right? And because it takes time, you need to let it do its thing. You need to let it season, you need to let it mature. And by the time you get to 6 to 9 months down the road, then you can only go back to that secured creditor and ask for an unsecured limit because you've established payment history, right? The other thing to it, and I want to be very clear about this, is don't think that you're going to get unsecured credit card by depositing $850 and only borrowing up to $10 to $15 at a time. You literally have to demonstrate the creditor the confidence in the ability that you can pay it down faster. So if you were going to deposit, let's say $1,000 for this example, be ready to borrow up to $300 to $400 at a time and be able to pay that as rapidly as possible, including, what I say rapidly as possible, I'm talking like, 60 to 90 days. And the reason this is critical is because that is basically unlocking a platform for the creditors to look at and establish payment history and look at the trends, historical trends that is, and that data that they can accumulate about your payment history, and from that make a determination on the type of unsecured funding they can give you down the road. And that should be your ultimate goal, which then what it does is it unlocks your deposits. Now you can transition that deposit into another institution and take that deposit and reestablish a new relationship, harvest a new one, and so on and so forth. This is a more secure way of doing it. But also what happens is the established relationships that you're building are going to have a lot more weight down the road. The weight that you're going to establish in terms of these established relationships, the tier 1 institutions that I'm talking about, when it comes to underwriting, will be able to give you the biggest boosts in terms of limits. If you can do this very securely and structurally, what you're going to do down the road is you're going to establish a very pristine AAA credit rating. Now, will you get into the 800 club? Possibly not. Right, in my last video and one of the myths, we talk about authorized users and what are some of the dangers of authorized users. If you want to check that video out, I'm going to leave it here so you guys can check it out as well. Just click on that little button and look at the video in reference to authorized users, what the future looks like and what you need to be careful with when it comes to establishing authorized users or perhaps even purchasing them. But moving on, you guys need to understand, like I said, 80% of your credit repair efforts should be enhancement, harvesting relationships, building unbankable ones, and especially enhancing your credit over time with these guys and establishing payment history. That's seasoning, right? On the other side, you're fixing and removing your negative items, but very strategically. Understand the way to question the creditors. Understand the way to question debt collectors. Understand what information needs to be put, how it needs to be put, they need to communicate with one another under institutional supervision, and what are some of the ins and outs of credit repair the proper way. Now, obviously, that's just a starting point. If you guys want to go a lot more in depth and learn a lot more content about this, you can check out my course, The Ultimate Personal Credit Mastery 3.0. The 4.0 is coming out very, very soon. I make that promise to you guys. And of course, I always try to keep my courses and material up to date. So if you want to check that out, check it in the link in the description of this video. But again, just moving on. Again, 80% of your credit repair journey and effort should be enhancement, harvesting your relationship, and seasoning those accounts, whereas the 20% should focus on removing of the negative items. A lot of people get into the credit repair game, like I said, with a misconception that just removing the negative items is going to do everything for them. And the reality is that couldn't be far from the truth. While you can be successful at removing negative items, the basis of establishing solid credit to be able to leverage and borrow requires relationships to be seasoned. Right? Relationships to have confidence in your ability that you can borrow, leverage, and growth along the way, progressive growth. That's what the trended data of FICO 10T looks like. So if you guys don't know how to do this, then my suggestion to you guys is, like I said, save up enough money, at least a good $3,000 to $4,000 if you can. From that amount, go and invest it with the banks, deposit it and borrow against that through a secured credit card, a revolving account. Over time, learn to borrow as aggressively as you can without passing a 50% threshold, typically 40%, and pay it as aggressively down, demonstrating payment confidence with the creditors. This unlocks them to say, hey, look, these individuals are customers, right? The ones that are paying very aggressively while borrowing almost close to 50% are very, very trustworthy, right? They're secured accounts. So what we're going to do down the road, we're going to unlock that security and let them borrow based on whatever they need. And in addition to that, we're going to give them strategic bumps along the way and just let them know that, hey, they qualify. And this is what you're looking for. You're not looking for hard inquiries. You're not looking to beg to go and do, a lot of shotgunning and credit card applications and hopefully stacking that up. There's no real goal to that. The goal should be establishing, harvesting, and seizing relationships. If you guys follow this structure, I promise you, you're going to get a lot more funding down the road. You might have a 720 credit score. You might have a 740 credit score, but the likelihood of you giving 50 to 100,000 is higher, whereas you can have an 800 credit score and you might only walk away with 30,000. So the goal is not about how high your score is, but the construction and the architect of your credit report itself. What does it contain? What are the relationships that are very obvious there? And what does the growth pattern look like? The 24 months of trended data. Is there progressive growth? Is there aggressive payments being made? Right? So these type of things really, really matter in the credit repair journey moving forward. So that's one of the myths I wanted to bust with you guys and let you guys know that, look, if you're looking to focus on credit repair, focus 80% on harvesting, growing, and seasoning relationships, and the 20% focus on removing the negative items, but know how to do it properly, right? Know how to do it properly, because that journey that you're going to take is a journey that requires patience, your confidence and conviction that you're willing to go until the end to get the journey complete. But also, you need to understand how to leverage that knowledge. And this is why the Ultimate Personal Credit Mastery is probably your best bet. Now, there's a lot of videos on this channel and a lot of other ones on YouTube that you can search. But if you're looking for a streamlined process of education, I encourage you guys to check out the course. And with that said, I hope you guys enjoyed this video today. If you did, don't forget to destroy that thumbs up button. Don't forget to share this video with those that you feel could benefit from the knowledge that I dropped for you guys today. In addition to that, leave a comment below on what are some of the next things you guys want to learn. Let me know, and maybe ask some questions that you want to see an entire video on that I'd be more than happy to go ahead and create for you guys. And with that said, this is definitely your guide and mentor, Ali Turafter. Catch you guys on the next one. Bye for now.